Hello, this is Saurav from Tax Accountant, and today I'd like to cover a very important topic, which is how to save tax. All of us, you, me, all the corporations in the world, they're always looking for how to save tax, how to maximize their cash flow, and bring more money in. So, how can you actually save tax? By not doing anything wrong, if doing everything proper, how you can do it. So this is just my 10 tips, top 10 tips, what I have learned over the last 15 years. I like to share that with you, how you can save tax in quick 10 steps. So step number 1 is accounts receivable. Look at your accounts receivable. Do you have any income or sales that you shouldn't be paying tax on? So remember another thing, accrual accounting. So accounting works on accrual accounting. When you raise an invoice has gone to the customer, whether customer has paid their invoice or likely to pay their invoice or not, you're still obliged to pay income tax on that. You might have raised an invoice which you got less likely to recover any money from it. There is no point you pay tax on that. Whether you put that credit to that invoice, bad debt to that invoice, get rid of that invoice, or do accounting adjustments. If you don't know, ask your accountant, ask anyone who understands the accounting concepts, so that you don't unnecessarily pay tax if you don't have to on that specific income. So second thing is assess your stock. So stock, if you understand the stock, this is a closing stock I'm talking about. It's a balance sheet item. It goes under assets, header, current assets under stock in hand. So the accounting formula is opening stock plus purchases less closing stock. So the level of stock that you have in hand that determines the cost of goods sold. So the less cost of goods sold will have more profit, and more cost of goods sold will have less profit. So depending on that, so quantify your stock. If you got any obsolete item, what's the point you carrying off that closing stock in hand? Get rid of that stock, sell it, so that you don't have to carry on that closing stock with you. Like that, you do your own assessment and do the necessary accounting entries with your accountant, or if you yourself as the accountant, do that things yourself as well. So the third thing, accrued expenses. Same thing, accrual of accounting. The concept of accrual of accounting is for sales, and same concept is for expenses as well. So if you do have some expenses that you're likely to pay for the associated income, so you can accrue for those expenses. So it could be a timing difference. For example, if the year end is on 31st of March, you got income coming in as of 31st of March from certain customers, but corresponding expenses related to that specific income are falling in April and May months in the preceding year. So you need to do that mismatch alignment, so that accrual of expenses can also come in that specific income year where you are going to pay tax. Accordingly, you can make the adjustments. Very important step, accrue for the expenses that you likely to spend later on. Holiday pay accrual. So this is specifically for New Zealand I'm talking about. This is the country I'm based in. However, in your country, you will also have some sort of stuff there as well for holiday pay accrual. So what is this? If you are likely to pay expense of holiday pay, like your staff wages, annual leaves, and their holiday pay. So if you have paid within next 63 days anything, that's also qualify as the expenditure for this year. So do not get rid of this expense. Could be small, but small things do matter at the end of the year, and to save you some tax as well. Fifth thing, business related personal expenses. You may be inclined to use some of those time, your personal cards, your personal things. If you're small business owners, we do it all the time. My clients do it all the time. So you do not have the card on you straight away. You end up using your personal cards. And at the end of the year, you do not forget to include those expenses. Bring back into the books as well, wherever you have used your personal things for business purposes. Entertainment expense, this is the sixth part. Entertainment expense is something when you take your clients out for dining, drinking, gifts, or anything like that. If you have done any of that, don't miss out on that. I often see these expenses are missed and we do not include that in our income tax returns. So, but if you have done something, do make note of it and do record all those expenses as well. Number 7th, review your asset depreciation. So your capital expenditure, go through your list of assets. What are the assets that you have? Are you claiming the depreciation on all those assets? Disposal, if you're not using any specific assets, get rid of that. So loss on disposal also is your expenditure. Do book that in as well. So depreciation, loss of expenditure, addition to the assets. If you bought some assets, make sure they recorded on the date the depreciation starts. Let's say you buy something in May, but accounting entries are done in December. So from April to December, 9 months of depreciation, you're missing that out. I often see that as well in clients' books. Why are we missing that out? Or the depreciation rate is incorrect. We should have depreciated at 30%, but we're only doing it 15%. So these small things, attention to detail is required in your asset register so that we get correct amount of depreciation in the books so that we can reduce our income tax liability. 3 more things. Number 8, home office. So if we're using part of our house for work purposes or part of our another location, not necessarily your house, but could be, might have another things that you're using for business purposes, any other assets that you're using for business purposes, we got to make sure we claim the expenditure relating to the use of that. Because the section DA1 in Income Tax Act specifically says nexus with income. As long as we can do the assessment of an expenditure with the nexus of income, that this specific expense is related to obtaining this income, we can claim the expenditure as long as we can find a link. The link has to be legitimate link. You can't have those unlegitimate link. Plus, a lot of the times case law has determined that this is not legitimate link. For example, a lawyer, he said, I want a suit for my client meetings, and they claimed the expenditure for getting a suit for client meetings. But the court said, no, this is not permitted because this is a personal expense. Someone has to dress up, someone has to wear something, so this is not an expenditure. But there is a catch. If you can justify this is not a suit, it's my uniform, and this is a uniform for all the staff, we wear the same thing all the time, here you go, you can claim that as an expenditure because this is a uniform. So small things matters, and this is how you can use it for your business purposes as well. 2 more things. Number 9, prepaid expense. Prepaid expenditure is also an expense that we can accrue for it in this year of financial year, such as if I have prepaid some rent. So certain prepaid expenditure are allowed. You can prepay next 6 months now. You can prepay something that's coming up now. So this is how you can reduce this year of income tax bill by doing some prepayments as well. Last one, use a business structure. So in your country, in our country, we always have some different business structures when we have different tax rates apply to different business structures, whether it's a trust, whether it's a special purpose entity, or whether it's specific company. So use the business structure, but this has to be done with a careful planning and assessment of your income, your entity income, and your associated parties income, all those income to be combined and see what's the best structure for you. So these are my 10 tips. Thank you for watching this video. If you like it, please subscribe to our channel. Thank you.